very strong jobs growth for December.
Yes, I think it was a strong print all round. So as you pointed out, 56,000 jobs, a strong number for December. Hours worked also rose. And the unemployment rate, although it ticked up a little bit from 3.9 to 4%, that's still a very, very low unemployment rate. It means that it looks as though it may very well be past its peak. Might have peaked late last year in terms of where, and it seems to be coming down, which is a good story. Within the detail, you can also find that the underutilization rate, which is something the RBA has been pretty focused on. They don't just watch the unemployment rate; they watch what's happening with underutilization. That's coming down. That's coming down too. So it looks as though the jobs market, which was loosening, it was gradually getting looser over time, and that was helping to bring down inflation. The jobs market now looks as though it's starting to tighten up. So this is good news for the economy in the sense that we, as you pointed out, are at a record high for employment to population. The unemployment rate's low, and there's lots of job creation going on. But it really does mean that it becomes less likely the RBA is going to be able to cut interest rates. If the labour market is so tight and it's tightening up a little bit further, then it's quite possible the RBA it may delay any plans they have or any thoughts they have about potentially lowering their policy rate. And we don't think in February they're likely to get there, but we obviously are going to be very much focused on that second piece of data that you alluded to, which is in a couple of weeks' time we get the fourth quarter inflation numbers, and they're going to be the critical feature for deciding, for thinking about what the RBA may do in February.
Paul, I know you've only got just a few minutes to look at the data sets, and I was just wondering if you could provide some bit of insights on where those job creation comes from. I mean, in the past, we've seen the public sector continue to punch above its weight, given it only accounts for 15% of the economy.
That's right. So we don't know in these numbers with very much accuracy about the breakdown across industries in terms of what's happening with employment. But what we know is that up to the third quarter last year, we had quite strong growth in public sector employment. It was driving a lot more, as you say, it punched well above its weight in terms of its share. It was driving about 40% of the jobs growth over the year to the third quarter, when in fact the public sector only accounts for about 15% of the jobs in the economy overall. So a part of it was and is likely to continue to be public sector job creation. But it is worth reminding ourselves that doesn't mean there isn't private sector job creation going on as well. In fact, private sector job creation has continued, and today's numbers tell us that overall the job creation is still quite strong, and the labour market is still it's still looking like it's reasonably tight. It's certainly below what the RBA or it's at the point where the RBA would deem that we're still either at or a bit beyond operating at our full capacity, at our full employment.
Well, now three major banks, CBA, ANZ and Macquarie, have called a February rate cut. What's your view, Paul?
We think that given the labour market has got so much momentum and that the unemployment rate is still very low, and in fact it looks as though it's come down from higher levels around about the third quarter of last year, so it may be that the unemployment rate has peaked. That's going to be a pretty important factor for the RBA in considering whether inflation will keep falling on an underlying basis towards its target. And we think, but when we get to the February meeting, that they're not going to be able to judge that they can necessarily cut rates. So we are still of the view that a rate cut is more likely to come in the second quarter of this year rather than at that February meeting. And one of the other, I guess the two other things we've been sort of emphasising is we shouldn't expect that there's going to be very many rate cuts, even if they do get going, because the labour market is actually still quite strong. And there is some risk. There is some risk that the RBA doesn't actually get to cut interest rates at all because of this labour market that's strengthening up, and because inflation, although it's coming down, has been coming down so slowly, and it is still, as you pointed out, on the monthly measure, above the RBA's target band. It was 3.2% on the trim mean as of the last numbers we got for November. So it's coming down slowly. The labour market's still tight. We don't think the RBA is going to be likely to cut its policy rate in February.
You've recently revised down the peak of unemployment rate to 4.3% for this year, 2025. Why is that?
Well, we just haven't seen as much loosening in the labour market as we were previously expecting. We were thinking through last year that the jobs market would start to loosen up a bit. There'd be a slowdown in employment and the unemployment rate might continue to rise further. And the unemployment rate just hasn't risen as much. Now, part of the story there is we were surprised how much job creation has been going on in the public sector, and that even though the private sector job creation has slowed a bit, it's been, there's been an offset in that public sector job creation. And we think that that's likely to continue to be a force this year as well. And so we think the unemployment rate, we previously thought it might get more towards the high fours. Now we're looking at our peak forecast is at 4.3. Obviously, that's above where we are right now. And so actually, there's an open question here as to whether it even gets to that level. Certainly, I think the wrap up for us would be today's numbers tell us that the jobs market is still strong. It's still strong. And the unemployment rate has really only risen a little bit when you think about it. Since late 2022, when it got to its lowest level in 50 years at 3.5%, it's very gradually climbed to 4%. And now it looks as though it's come down a little bit in the last few months.
Before I let you go, Paul, an interesting survey came out today by global recruitment agency Robert Walters, showing the use of AI are highly encouraged by employers across many sectors. What's behind that drive and how the use of AI will impact jobs? I mean, after all, wages are a big part of costs of doing business.
Well, one of the fundamental problems we've got in Australia is that productivity has been really quite weak. And for all the talk of the strength in the labour market, the productivity story is really what we ought to be very focused on. So one of the ways to potentially lift productivity is to find ways to innovate. And of course, artificial intelligence, AI, represents a way to do that. And so I think we are going to see more and more of that sort of consideration of adoption of AI in terms of finding better ways to do work practices. And that in turn should help to lift productivity. And it's great that firms are looking, and the surveys are showing that firms are looking for ways to do that, because that is one of the mechanisms for lifting productivity. The thing I would point out, though, is it's going to take time. It'll take time for that effect to start to feed through. So, normally when big technological things come along and adjust, that takes a while for firms to work out how to apply it, and it takes a while for it to show up in terms of productivity. But certainly promising signs for more innovation and adoption of things like AI in terms of improving productivity.
Paul Bloxham, Chief Economist at HSBC, thank you so much for your insights.
Thank you.